New CPI data was just released showing a small uptick in inflation over the last quarter. But the bump was small. In fact, nowhere near what it's been the last few years. Year over year, inflation has in fact finally reached that long-term target of the Federal Reserve of 2.5% to 3%. Here you can see the Consumer Price Index rate of change over the last 5 years, and there we are down below the 10-year average. So what is this likely to do? How's it going to affect you, mortgages, the stock market, and everything in between? Well, there's two answers. There's an answer of what's going to happen in the next 12 to 24 months, and then there's what's going to happen in the next 5 to 15 years, and they're very, very different. My name's Ross Gibbons. If you haven't already, guys, please click down there, subscribe to this channel. I'm going to start putting out content more often, both giving some big picture ideas as well as some individual trade ideas each and every week. So love it if you subscribed. You get notified when those come out. But let's break this down really quickly, okay? So the market has been waiting for interest rate cuts. In fact, we've really been waiting on this for the last 5 years. But the Federal Reserve has delayed doing so. And that's their job. Interest rates are their main tool. If inflation gets too hot, asset prices are rising too much, they raise rates like they did in 2022 to discourage lending and borrowing, suppress growth, and get prices back down. When it's the other thing happening, inflation is very, very low, they can cut rates and spur economic growth, right? You're more likely to build a house or build a warehouse or expand your business or borrow, et cetera, when rates are low, and it stimulates the economy. So that's what we've been waiting for. And Trump has made no apologies about being insistent that interest rates are way too high. He believes 3% too high. He has a cute little nickname for Powell, of course. He generally does, calling him Too Late Powell. But whether he's right or wrong, I don't know. But the fact is, Powell's term is coming to an end. And the President of the United States appoints the next chairman of the Federal Reserve. Now, a lot of analysts believe that Powell's going to cut rates in September, which I think he might cut once. But they're also forecasting 6 to 8 additional interest rate cuts in 2026. And make no mistake, Trump will not appoint anyone who does not further his agenda and he believes will do as he wishes and aggressively cut interest rates. So here's how that is going to play out, both over the short term and the long. Now, in the short term, this is the 30-year mortgage rate. Of course, we had the glory days of 3% back here. For you guys who locked in a rate there, I hate you. I'm kidding. I'm jealous. But now we're up here at 6.7, 6.5, 7%. What is likely to happen over the next, I'd say, 12 to 18 months? Trump will, by whatever means necessary, get this to happen, and we will, in fact, probably see interest rates near 5%. And when interest rates fall, what goes up? The stock market, right? Well, typically when they're cutting interest rates, it's because the economy needs stimulation. The market has just tanked like happened in 2008 or happened in 2020. But right now, the NASDAQ Composite Index is sitting at all-time highs. You aggressively cut interest rates when inflation is low, the market's at all-time highs, growth is good, this market is going to soar. So we're expecting a very, very strong stock market over the next 12 to 18 months, fueled largely in part by this big slashing of interest rates. But after that, after we get down in there, and maybe 2 years, 3 years, it starts to reverse, I don't think we'll ever see 5% interest rates again, at least not in my lifetime. And the reason is the government can't stop spending money. Now, we all know that the national debt is out of control. As of today, the United States is $37.1 trillion in debt. This is $108,000 per man, woman, and child in this country. That is $323,000 of debt for every single American taxpayer. It's a number that they have long accepted they will never pay off. In fact, if you look at our debt as a percentage of GDP, the gross domestic product, you see that it would take every penny of every good, service, or value created in the United States by every single worker for an entire year, and we still wouldn't pay off the debt. So we are long past the pipe dream that this will once be paid off. All they are trying to do is just manage the situation. But the situation is horrendous. We all know we have a deficit. In fact, it's become normalized, though it shouldn't be normal, that our government spends massively more than it brings in every year. But that's been the case for the last 30 years. That's why the national debt goes up every month, every quarter, every year. But even if they wanted to cut, which I don't think any of them really do, they just can't. The total revenues in 2024, as you can see, around $4.9 trillion. Half that came from income taxes, then payroll taxes that go to cover, Medicare, Social Security, corporate income taxes, and a few others. The government spent, however, $6.8 trillion, nearly $2 trillion more than it brought in. This is not, I went a little bit over budget this month, honey. This is, we spent 23% of the nation's GDP. We have nothing to show for it. And look at the breakdown here. This outer blue circle, that's the mandatory spending. That stuff can't be cut. Medicare, Medicaid, Social Security. I mean, you paid Social Security. It's your money. They can't take that. The net interest on the inner circle there in brown, that's not going to change. In fact, that's going to go up. You borrowed the money. You have to pay the interest, and that number goes up every single day. The defense budget here in dark green, around $850 billion as of today. They may trim that some, but I can't see a situation where the government no longer has the largest military in the world. So even if they really got aggressive, the only area they can really cut, and they even have a discussion to cut, would be this area here, this non-defense discretionary spending. But look, the Doge team, and I don't care how you feel about them, the Doge team, when they're tried to make massive cuts, this is the section of the pie they tried to cut out. This little area right here. And the backlash they saw and the protests they experienced were massive. Even if they were successful in this, we'd have still had a massive deficit. So D.C. is never going to stop spending. They will always spend more than they take in. And so if you're managing a debt situation and you've got more money going out than coming in, you got two options. Make more or spend less. Now, the government doesn't actually make anything, no goods, no products. They're making money. It's just taking it from you, me, the other taxpayers, and, of course, corporations in this country. Well, they could raise taxes. They could increase the upper limit because the lower half of the population pays zero, but they could raise the upper tax bracket. They'd have to be very aggressive with it. They'd have to get it in the 60, 70% range to make any meaningful change to that deficit. And if they did that, and we've seen this attempted at several other countries over the last decade, the top earners would simply flee the country. They have the resources, it makes sense to do so. They would go somewhere they're treated better. You could raise the corporate taxes. Same thing. Businesses move overseas to avoid those taxes. So I've never seen an example where they massively raise taxes and it actually brings in more money. Usually you just get some of those taxpayers leaving the system, going to other countries, etc. So if you can't raise taxes, you got to spend less. But they're not going to spend less. As I just showed you, if they wanted to, they can't. So there's really only one tool at their disposal, one other way to bring more money in that's not increasing taxes, and that's firing up the old printing press. They just print the money out of thin air. They do this by issuing bonds that just came out of nowhere. They just created them, sell them on the open market or bond auction. That money goes into the vaults of the U.S. Treasury and spent to fill these gaps. But we have long passed the point of no return. According to estimates by the Congressional Budget Office, which is generally on the low side, they say that by 2035, the total tax revenues will only be enough to cover interest on our debt and Medicare. Everything else, you got to print. And what happens is you get this domino effect where the deficit gets wider and wider and wider and wider. As that happens, you print and borrow more and more and more and more. And that just increases the amount of money you're paying interest on, which then increases the expenses, which makes you have to print even more. And it's just this vicious cycle that goes parabolic and really gets out of control quickly. And so short of, defaulting on the national debt, which would be a catastrophic situation, a shock to the financial markets, likes of which we have never seen, with runs on the bank and just a total collapse. I don't think anyone would ever do that. Short of that, it's the only option they have. And so here's what's going to start happening. In fact, it's already starting to happen. People are seeing the writing on the wall. If you take a look at gold, you see that it has steadily risen over the last 18 months from around $2,000 an ounce to more than $3,400 an ounce. My expectation is that this is just the beginning. I think gold will see $5,000 to $8,000 an ounce over the next 2 years. And this is simply a result of people seeing that the dollars are becoming more and more worthless. No one wants to hold dollars. They're worth more each year. Your purchasing power is degraded almost daily by the Federal Reserve and the amount of money they're printing, so folks are flooding to gold. We're also seeing weakening demand for federal bonds. You know, when you've got the wealthiest country in the world and all this tax, sure, yeah, I'll take 3%. It's free money. It's guaranteed. But as that image of security starts getting chipped away, and again, I think it's already started, and as investors in the rest of the world realize that, man, they're never going to pay this stuff off. They're getting to a point where they may not even be able to pay the interest on it. Investors will demand a higher and higher interest rate for those bonds. That's how the world works. If you're going to borrow money from Uncle Sam, sure, you'll take 3 or 4%. You know he's good for it. If you want to, lend money to some kid with a startup company where he's trying to, sell sweaters for dogs, that's a little riskier. You're probably going to require a higher interest rate. Well, it's the same thing there. And unfortunately, government bonds set the pace for the rest of the debt market. Anytime government bonds are at 2%, you'll get mortgages at 4 or 5. When the government, when national debt, when bonds were paying 8, 10, 12%, mortgages were 13, 14, 15%. And that's where we're heading again. And so it's a vicious combination coming, not today, not next month, not next year, but 5, 10, 15 years, without question in my mind, you're going to see massive inflation. The results of this money printing are going to go parabolic. As the debt increases, the deficit widens, the amount being printed increases. And that's the only thing that caused inflation is government printing money. That's why it happened in 21 and 22. They all went crazy, printed trillions after COVID to fill the gaps. So you're going to have this record inflation. It's going to drive gold up and cars up and real estate prices up, while at the same time, interest rates are going to creep up 7 and 8 and 9 and 10 and 12 and 14%. And so we already have a housing affordability crisis on our hands. It's about to get a hell of a lot worse. So it is my belief that over the next 12 to 24 months is going to be the best and final opportunity to lock in affordable real estate prices at a low interest rate for the next 1 to 2 decades. Just like we look at people who bought at 2020 prices at 3% interest, that's how people in 2030 are going to look at us with a 5 or 6% mortgage. And just like it's happened over the last 5 years, real estate values will continue to surge. Interest rates will climb at the same time. The affordability will continue to decline. And if anything, again, just following the data here, the rate at which it does this is only going to speed up. So, do with this what you will. What I suggest, what I'm doing myself and advise is a couple of things. One, own some inflationary assets. Gold, for example, tends to rise with inflation. Real estate, things like farmland, where the value of the goods that farm produces will rise in pace with inflation. Commercial real estate, residential real estate, apartments, that kind of stuff. Asset prices rise. You want to own assets. You want physical things that will rise in value alongside that. I would also encourage you to lock in the debts you can in the next, again, 18 to 24 months. If you get a chance to lock down a mortgage anywhere in the 5s, I would step on it and get where you want to be the next 10, 15, 20 years. Lock that payment in, because if you don't, you could be completely locked out. So that's how I see this playing out. Now, listen, I'm not trying to be doom and gloom. I hope I'm wrong. I hope AI brings through massive GDP growth, huge phase of productivity. I hope that tax receipts surge. We have a surplus. All this is kicked down the road. But even if that happens, I think we're really just, as I said, kicking the can down the road. You can't spend more than you make for 30 plus years and expect there not to eventually be consequences. I don't like that we're the ones to deal with it. I like my kids to deal with it, but that's the fact of the matter. And whether this happens in 5 years or 10 or 20, it is going to happen. So do what you can to protect yourself. Own recessionary assets. And if you're thinking about moving, I'd try to do so in the next 1 to 2 years.